Hello, my name is Sina Sibia. Thank you for listening to this podcast. I'll be taking you through a performance update of the GBL Specialist High Growth Portfolio to the end of the first quarter of 2022. The portfolio's objective is to generate returns geared towards long-term growth. With a target of CPI plus 5, the long-term nature of this portfolio means that over the short term, returns are likely to be volatile. Ideally, an investor should have a minimum of 5 years to retirement. Looking at the structure of the portfolio, we see that as the name does imply specialist high growth, it is a growth-oriented portfolio with a high allocation to the growth-oriented asset classes. When we look at the allocation to the local equities, we see that it is at 46.8%. Then there is also an allocation to the other asset classes. The portfolio is diversified across the different asset classes as well as the different underlying managers. We do also have an allocation to global assets at 26.4%, to alternatives, which are the unlisted securities, at 10%. Then there's an allocation to the tactical building block at 7.6%. This is the building block that allows the portfolio managers to make some tactical calls given the strategic long-term weights in the portfolio. This allows the portfolio managers some flexibility to make some tactical calls. Then there is also an exposure to local bonds at 4.8%, and an exposure to property at 3%, and Africa at 1.4%. The portfolio marginally underperformed the benchmark over the quarter and was in line over the 1 year period. The main drivers of performance in these time periods are predominantly pure equity local and the local alternatives allocation. The long-term periods is where the portfolio has struggled the most, with select building blocks underperforming their respective benchmarks for a variety of reasons. A decision was taken in the first quarter of 2022 to add to local equity over the global allocation, which contributed positively as the South African market stood firm compared to the rest of the world that was in negative territory. The view was that South Africa would suffer the least in this environment due to its resource-centric nature. Our position was opportune, so we would be able to latch onto the rising commodity prices and benefit from them as we have, with many market commentators classifying South Africa as a safe haven for global investors. Over the quarter, the pure equity local fund has underperformed its respective benchmark. This is attributed to mainly two factors: the Russia-Ukraine conflict and the continued Chinese regulatory pressure on the tech sector, resulting in underperformance from the likes of Tencent. The equity managers who suffered under these factors were Excelsior and Benguela, which were also underweight gold, which hurt performance. In terms of how the Russia-Ukraine conflict affected these managers, is around how the conflict increased commodity prices, and these two managers were underweight the resources sector. The China effect came through the overweight allocation, as both managers had exposure to the Naspers and Prosus stable, which got hit by the Chinese regulators through Tencent. Looking at the other managers, M&G, despite underperforming the benchmark, managed to deliver positive absolute returns, with positive contributions coming from their investment in Sasol, Standard Bank, and Absa. 361, who were the best performing asset manager in the pure equity local building block, also managed to register strong positive absolute returns, with key contributions coming from their holdings in Standard Bank, Glencore, and Sasol. The exposure to domestic hedge funds contributed to absolute returns and outperformed the specialist high growth benchmark, with a strong South African equity environment over the past 12 months. In particular, the equity hedge component performed better than the fixed income hedge strategies led by long short bias managers benefiting in an up market. Globally, the rest of the world wasn't insulated from the Russia Ukraine conflict, along with the inflation rising, the Fed being more hawkish, and China's zero COVID policy. In terms of Africa, even though the market was significantly down due to the biggest weighting in the benchmark, during to during Egypt suffering the most due to the Russia and Ukraine conflict, the fund held up well. The pure fixed interest local managers also did very well, with their positioning on the longer end of the curve driving their good performance over all time periods. Then once again, just looking at the asset allocation of the portfolio, in particular the combined combinations, the combination of the local components, Africa components, and the global components. As we can see, the portfolio has the highest allocation to equities, with the combined allocation being at 67.4%, property at 6.8%, bonds at 14.2%, cash at 3.5%, and the alternatives at 8.1%. Thanks again for listening to this podcast.